Hey friend, welcome back to the channel. I'm Jeremy. I'm a designer and co-founder of Yielder, which is a tool to help you manage your dividends and research great stocks. And today we are talking about creating a thesis, and we're going to go over a framework to help you understand why you own a stock, why you own what you own. Now we are stealing this from one of my favorite books and investors, which I call him Uncle Peter. This is Peter Lynch and One Up on Wall Street. This is one of the first books that I read when I got into investing because it's all about encouraging us as everyday retail investors to invest and to get going and to find stocks. He actually says that we have an edge over the professionals because we can look around us at products, companies, businesses that we're already using, and that provides us a good foundation. He also says that we don't have time limitations that fund managers have, where they have to show results every quarter or year, that we can hold stocks long term. He's also clear that this is just the starting point and that we need a framework so that we can analyze these businesses, know why we own them, and monitor them along the way. Now, when we go to buy a stock, we can't borrow conviction. And what I mean by that is you can't just listen to me or some other YouTuber or podcast or CNBC and go and invest in a stock blindly. You can't borrow that because when the going gets tough, you're not going to understand why you own it in the first place, and you're most likely going to sell at the absolute worst time. And Peter Lynch in this book gives us some quotes to help get us going in the right direction. He says, know what you own and know why you own it. And the second thing he says, which I love this, if you can't explain it to a 10-year-old in 2 minutes or less why you own a stock, then you shouldn't own it. So today, that's exactly what we're going to do. We're going to create a stock thesis for all 12 companies that I hold in the Dividend portfolio that I'm building here from ground up on this channel. So I want to share you one more quote here to help you understand what this thesis is all about. So this is from Anthony Bolton, which is an investor. He was famous for fun at Fidelity. And he says, know why you own a stock. That sounds familiar, right? Every stock must have an investment thesis. The thesis must be retested at regular intervals, and a counter thesis should also be in place. What might lead to it becoming a bad stock? So I put together this framework that you can use, and I'm going to walk you through how I'm using it for all 12 stocks. So the first thing is you want to know how your company actually makes money and what competitive advantages do they have. So this is the moat. The second thing you want to know is how will the company grow? What opportunities do they have? Because this is something we want to monitor to make sure that they are taking advantage of those opportunities. And three, we need to know the risk that the companies are facing. Now we take all three of these, and this gives us that checkpoint where we can look back at our companies to see if it still aligns with our original thesis. So let's go ahead and let's jump in here. We're going to start with Visa. Now, the moat around Visa is that they are the digital toll booth for payments. So, you probably have one in your wallet, all your friends, your parents, everyone has a Visa credit card. So every time someone swipes a card or taps their phone, which I always have trouble like even tapping my card, I always feel like an old guy when I can't get it to work. But anytime someone does that, Visa takes a tiny piece of that transaction. So they get paid every time a card is swiped. There's a lot of international opportunity here for Visa to continue to grow as more people start using digital payments and start using Visa products. The second thing that Visa has in their favor is value-added services. So this is when they're expanding beyond just the credit cards and the debit cards, and they're getting into new areas like B2B payments, government disbursements, and cross-border solutions. And this is also services that they can add on to corporate customers that they already have. So these are security things to help protect their customers. So they have all these avenues that they can look into to expand and grow. But with any great business, there are risks. And there's a few risks with Visa. One, governments could come in and put regulations on Visa that cap how much money they can make. And there's also new technologies coming along that can help businesses or even countries bypass the Visa network altogether and develop their own rails. Now, the third piece here is stablecoin. I put a question mark there because stablecoin is something that Visa isn't just sitting back and let happen. They are getting involved and getting a seat at the table and actually leading the discussions on stablecoin. So this could be an area that they really grow. It could be an opportunity, but it could be a risk. We have to wait and monitor this to see how it plays out over time. All right, so that's Visa. Now let's move into automatic data processing. So ADP is the leader in HR and payroll services, and they handle this for a large number of corporations. And this is crucial. This is one of those things that you don't think about, but every time your company pays you, there's a good chance ADP is behind the scenes making that transaction happen. And I know from working at a large company and working in IT, this is something that an executive does not want to mess up. Okay. They don't want to try to mess this up and not have payments go out. You can't get this wrong. So this is a crucial piece every business needs in order to transact, pay their employees. And I don't see it going anywhere. Now, ADP has been around for years, but they have some growth potential still, and that's transitioning their clients to their next gen human capital management platform. So this is all about agentic AI. So this is having their clients use their system and then add in these services where AI agents go and do things for their customers. And instead of the customers going and building this, they can just add on to the ADP services they already use, and it's going to help make their IT and HR departments more efficient. Another thing you may not know about ADP is there is this float. This is kind of the money that they collect from the companies, and there's a time period where they have the money and they have to make those payments to pay all the employees, and they can take that time, take that money, invest it, and they can actually make interest on that money. So they have a few headwinds here that they continue to leverage and use. But of course, ADP has some risks. So you have some newer companies that maybe have some nicer UI, companies like Workday that can come in and start to steal their customers. And there's also the risk of just companies saying, hey, AI is getting so efficient. I can just use AI to build my own internal payments and HR systems. And another threat that is always hanging over ADP's head is recession, because the more people in the workforce, the more payments are going out to pay employees, the more money ADP makes. So when there's layoffs and recession and job cuts, then ADP can suffer from that. So these are all things that you want to monitor and come back to later. So if the going gets tough on ADP, we can come back and see, does the thesis still hold up where it is today? Next, we have Accenture. Now, they are the tech consultants. They are one of the largest consultancies that help corporations transition to the cloud, transition to AI. If a company needs to make a move, they hire Accenture to come and help them make it smoothly, because they can lose a lot of money if they mess up the transition and the implementation of new technology. And their growth area is just in that. Technology is changing fast, even faster now with AI, and these companies don't want to be left behind, so they want to hire Accenture to make sure they do it right and have the latest and greatest tech that they're working with. And they have this new initiative called Total Enterprise Reinvention. And this is where they aim to help clients rebuild their core technology stacks with, once again, generative AI. So they want to help these companies learn how to leverage AI, use their AI to help implement solutions. So not only are they helping companies, use AI, they're using AI themselves to make them more efficient and add value on services that they can offer their customers. Now, the risk with Accenture is, what if AI gets so good that companies don't need Accenture because it's so easy to implement, so easy to use, that they don't need to pay expensive consultants anymore? That's their biggest threat, and that's what we have to look for in the future. All right, so next we have Allstate. I'm sure you know them as one of the largest home and auto insurance companies in the world. And these are two areas that people can't ignore. You either legally have to have insurance, or you practically can't skip out on it, because if a worst case scenario happens, you just can't front that bill and you need that insurance in your back pocket. Now, Allstate also has decades of data, so they're able to use this data to help predict what kind of payouts they're going to have and ultimately help them raise their prices and stay on top of it and continue to grow. Now, Allstate has a couple growth potentials here. One, they get float, which is similar to ADP. This is money coming in from their customers that they haven't paid out in claims. They can use that money that's unspent, they can invest it and grow their profit that way. And they also have what they're calling their protection business. So they want to modernize this, bring this up to modern day times, I suppose, and make it more digital. So this helps customers, it helps them cross-sell to customers right in the experience, and it also takes some of the weight off their customer support, how they underwrite their insurance. So this helps them improve their margins. Now, they have a few risks to look out for. One, is what happens when electric vehicles and even self-driving cars, if we look out in the future, start to really get adopted in areas and catastrophic events actually decrease. Will they have to lower their fees? These are all things that we don't know and just need to monitor. And then they have catastrophic events themselves. What if all of a sudden something major happens, they get all these claims coming in, and they have to pay out? This could raise their costs faster than they can raise their prices, and then it sits them behind and starts hurting their growth potential. All right, next we have Microsoft. Now, I can tell you from experience working at a large corporation that we use Microsoft all day long. And it's really hard for corporations to make it today without all the services they get bundled in to Microsoft. They literally are the digital plumbing of the corporate world. And you have all these services: Windows, Office 360, Teams, cloud infrastructure, Copilot, AI. You have all these things that customers can come and get all they need in one place. Of course, Microsoft has a lot of growth opportunities because they have so many different businesses and products that they own that they can always upsell to their current enterprise clients and just keep adding on more services. And another thing about Microsoft is they don't always have to be the most proactive company. They can kind of sit back, and when a new company comes along, a new startup, take Slack, for example, where Slack starts taking over the market with giving companies a way for the employees to talk and communicate. Well, Microsoft can just say, hey, that's a great idea. Why don't we build that and offer it to our customers that we already have? So they can create Microsoft Teams, and instantly they can compete with these startups because they can just adjust the price a little bit for their clients and give them the same exact feature. And they're also growing their cloud data centers so they can handle more demand. And this is a major profit generator for them. Now, on the flip side of that is the risk. So what happens if they're overspending on AI? And we come to this point where there's not enough demand, and they built these data centers and they built all these products and they can't fill it. So that's always a risk that a lot of these hyperscalers are facing right now, and Microsoft is no exception. Microsoft's unique because they're kind of in this middle place where they have to grow, they have to invest in this because this is their biggest opportunity with AI, but also customers could at some point start building their own products internally and using AI to build it and not necessarily need Microsoft as much for some of their products and services. And the other thing, which has happened, is there's a massive security cyber attack that affects their networks. They start losing trust, and people just get tired of the downtime and the attacks, and they just go somewhere else. All right, next up we have Snap-on. Now, they build tools. If you want to just strip it down, that's the simple thing. They build tools that mechanics in different industries can use. But what sets them apart is their relationship. So professionals have come to love Snap-on tools because they're high quality, and the fact that they have this mobile van come to them every month, every week, that can help replace their tools, give them better tools. There's this direct relationship with the customer that other companies and brands just don't have. Now, I think one of their biggest growths, and they've identified this as extending in the critical industries, and this is them kind of growing their industries in the aerospace and the manufacturing and warehousing, and get out of their largest segment, which is the automobile mechanic world, and get into these other areas. I think there's a lot of opportunities where they can start to take over in those spaces as well. Now, the other growth is also the risk, and that's with hybrids and electric vehicles. These cars are becoming more digital and more complicated, which needs diagnostic tools that Snap-on can provide. But on the other end, there's less moving parts, so there's less tools needed to fix these cars because it's all handled in the software. And the other risk they have is just cheaper alternatives. And this is when you have even a company like Harbor Freight. They've created a tool line to directly compete with Snap-on. So they always have these competitors coming at them, trying to dethrone them from the professional loyalty that they have right now. All right, then we have a completely different type of company, and that's Torino Realty. Now, I love this company because they are industrial. They own warehouses in 6 key coastal areas. So we're talking LA, New York, Miami, Seattle, Virginia. These are places where space is limited. There's water on one side. There's not a lot of space to expand. And they own a lot of the warehouses that shipping companies come into and businesses need to operate. So they are the middleman here for e-commerce and goods moving throughout the country. And their major growth area is that the space is limited, right? They have these strategic places where they operate, And they know it's really hard for other places to come in and build because there's just not enough land. And that leads to really their main strategy and their main growth point is what they call the fix and lease up acquisition strategy. So they don't actually build up warehouses on land and buy land. Instead, they wait for opportunities where they can buy nearby warehouses and buildings, and they fix them up, they buy them at a discount, and they bring them into their system, get them fully occupied, and start making money off of them. Now, the risk here, I think, is a little far-fetched. What if people start to move away out of these coastal cities, or goods stop coming and going from the country? I mean, I guess these are risks that could happen. I think they're far out there, but you do have to monitor and consider that. I think one thing you can look at is their occupancy rate. I think they have around 98% occupancy levels across all their properties. So this is a good metric to monitor to really understand the health and the growth of the business. Now, another piece is just governments and zoning laws that could come in and change that could, shift their businesses. But again, I don't see that happening so much because they really do have a strong foothold in where they're at. They have good relationships with those local governments and they're bringing in a lot of money for them. So I think this is a pretty stable company, but with every company, you do have to monitor these risks. So we define them, we put them in our thesis, and we know what to look for in the future. So next we have Rollins, and they are the leader in pest and bug control. And you may know them around where I'm at in Virginia. I know them as Orkin, but basically they own tons of different brands that operate in different parts of the United States and even different countries, and they operate under these different brands. So their strategy is they buy up these companies that are smaller, they bring them into their ecosystem, they make them more efficient and get it to where they can start producing more profit. Their whole moat is that you can't mess around with termites and certain types of pests. You have to take care of that. You can't let that go or just skip on it. So this is something that they can have recurring payments coming in, recurring customers, and they can continue to grow through acquisitions. Now, one growth area that they have is commercial. So they already have a commercial business, but they can continue to grow this, get into restaurants, hotels, even warehouses. Maybe they can team up with Torino Realty and they can be a customer of theirs, but they have a lot of opportunity to grow in this corporate landscape, which I'm assuming would be higher margins, and because it's just more efficient to get a customer that has a larger scale that you can service. The risk here is some type of recession or economic downturn. I think this would affect more of our residential people where they're getting strapped on their monthly cash flow. So they just cut Rollins and they start trying to do it themselves, or they just skip on it altogether. So this is a risk that you got to look at. I think a recession could hurt Rollins, but they've been around for a while. They've navigated this before. So again, it's just good for us to monitor and look out for. All right, next we have Zoetis. They are the leader in pet and livestock pharmaceuticals. So this is an interesting company here because it's a little different from your pharmaceutical companies that deal with human medicines. This is for pets and animals. There's less restrictions and controls and really less competition. And we all know people love their pets, and very unlikely you're going to cut costs on medicines if your pets need them. And they also have a major growth opportunity with livestock because this has came up in the news a lot with diseases and things that can affect certain animals that then affect what we eat. And Zoetis is there at the forefront, making sure they're staying on top of it and coming out with new solutions to help keep our livestock healthy and help keeping us quality food so we can all live and sustain ourselves. So they have this big advantage, and this is a growth opportunity that they can continue to move in and be proactive. Now, with any pharmaceutical company, I do see some risk. And the first risk is eventually their patents could run out on certain popular medications, and there could be generics that come and compete for them on price. And the second threat, and this has affected Zoetis, is when their reputation gets hit because there's drug side effects that affects our pets. And we know if you have an unhappy pet owner, they're going to make some noise and make sure that they are hurt. So this can really damage the reputation of Zoetis and something that they have to keep monitoring and staying on top of. All right, next we have EOG Resources. So they are an oil and gas exploration company. So they don't necessarily bring it to the pump like your Chevron and Exxon. They're out there actually finding new places where they can get oil, and they are drilling and extracting it from the earth. So they have a couple advantages. They have geographical and operational cost advantage because they have been around for so long, and they have some strategic locations in the US that they operate. Now, they don't always own the land itself, but they have legal contracts or leases that they can extract oil from the most profitable places in North America. And they have this technical engineering behind them to help make it more efficient. And they're continuing to advance that and be able to make more profit per site. And that's really where they're leaning into. And that's their growth. They're calling it the double premium drilling. So this is specific areas where they know they can make higher margins, and they want to kind of shift because they have all these different places where they're drilling. They can focus on the areas that make them more money and lean into that. So this makes them more efficient and, again, just more profitable. But like all these other companies, they too have risk. And that is, one major one that I think about a lot is, what if they just exhaust their inventory and they just drill all that they can drill? And they have plenty of years of reserves, but this is always something in the back of my mind with all the oil companies. And also, because they're an exploration company and they go out and discover land and discover places where they can drill looking for oil, they're spending money doing that. So what if they spend so much and don't have the oil there to make the profits on? And the third risk that I see with them is they're mainly focused in the US. So if there's changes in domestic fracking or drilling or restrictions, then they're definitely going to feel that. I think we're at number 11, and this is TJX companies. Now, my family loves this. I love shopping at this. I'm pretty sure I got this shirt at TJ Maxx, but TJX is the power behind TJ Maxx, Marshalls, Home Goods, HomeSense. They own all these discount retailers, and they have this massive global relationship and supply chain with designers and brands where they can buy overstock clothing and items cheaply and then offer the discount to their customers. So they kind of win in any economy because people will shop there when they're strapped on cash, but they'll also shop there when they have money because it's just a fun place to go and treasure hunt. I think one of their biggest growth opportunities is expanding their business, taking what's working well in the US and going into other countries with the same model. They're already doing this with Canada and New Zealand, but they have opportunity here to really add more stores and more profit. The risk they have is some brands saying, hey, I don't want to just give this away to TJ Maxx. Why don't we come up with a plan to take our excess clothing and create our own outlet or discount stores or do it online and kind of bypass TJX altogether? So that's a risk. They do have such a big supply chain that they worked on over the years and grown that I think it's hard to, a brand on its own to do that, but it's always possible and something that we need to monitor. All right, finally, we get to our 12th stock. The company is Main Street Capital. Now, they are a private lender, but they're also, with some companies, an equity partner. So they lend money to mid-sized American businesses, but they also take part ownership in some of these businesses. They have this strategic place in the market where a lot of these businesses, they can't go and just get money from a bank because they're too small, but then they might be too big for your credit union or your neighborhood bank. So they find themselves in need of lending, in need of funds to grow their business, but no one who's going to give it to them. And that's where Main Street Capital comes in. And their growth potential is just continue to expand and buy more of these companies and build out their portfolio. One unique thing about Main Street versus a lot of other business development companies is they can keep their costs low because they're internally managed. So this is a big advantage for Main Street because they don't have any outside factors. It's just them managing the company, deciding who they're going to loan to, and they don't have to pay fees to bigger banks or bigger organizations. Now, their risk is kind of twofold. One, they have the risk of recession, which means some of these companies that they're giving money to and have loans with could default. Maybe they run into hard times and they can't pay the loan. So the second risk they have is lower interest rates. The main strategy of making profit for Main Street is to have a loan to a company, and that company has to pay interest. And that interest is the profit that goes right back into Main Street for fronting them the money. But when interest rates lower, that rate comes down, so they're making in less profit. So lower rates eat into the profit. All right, if you are still with me, then first of all, thank you, because I appreciate you hanging with me as we go through what a thesis is, a framework, and then literally walk through creating it for all 12 companies in the portfolio. I hope you learned something. I hope you can take away pieces of the framework. You can start to do this for your own companies and the businesses that you hold. Remember, this is for us to look and know what we own, but also be able to come back to this at any time so we can make sure our original thesis still stands. So again, thank you for coming. Thank you for checking this out. Until next time, happy investing.